Okay, let's do the built-in gains tax. Built-in gains tax. Okay, and this is called the big tax, section 1374. Now this tax is computed on the built-in gains. Okay, and we know what a built-in gain means. So in this case, the built-in gain is going to be the gain that exists, that or let's say it's the potential gain at the time the C corp became an S corp. Okay, so that's what a built-in gain means. Okay, in other words, it's like, what is the gain? Is, remember, when the gain is taxed at the C corp level, gain on any assets, they all pay tax at the corporate rate. Okay, and when it flows through, and then of course pay tax at the corporate rate, and then it's subject to a double taxation when it's declared as dividends, right? Now, when it becomes an S corp, it escapes the corporate tax, right? And it just flows through to the shareholders. So what this tax tries to do, if you think about it, is essentially say, hey, since this was a gain that you made at the time you were a C corp, I'm going to make you pay the C corp income. So this is not a gain that was recognized, that was not even realized, but only a potential gain. Okay, so we look for basis and fair market value, okay, at the time the C corp becomes S corp. Okay, and this is called the built-in gain. Okay, and we can also call this as unrealized built-in gain, because nothing has been sold at that point. When the C corp becomes an S corp, nothing is sold at that point. It's all the C corp assets. So this is fair market value of the assets minus the basis of the assets. Okay, so that's really what the unrealized built-in gain is. Okay, now when each of these assets, okay, whatever these assets were existing at the time of the C corp, when these assets are disposed of, okay, the S corp will have what is called as recognized gain or loss. Okay, because when the S corp then sells any of these assets, that's when the S corp is going to recognize these gains or losses. Okay, so we have now two items. Okay, for the built-in gain, we have unrealized built-in gain. Then we have recognized built-in gain. Okay, recognized is when the assets are disposed of. When assets are disposed of. Okay, and then the last one, of course, is the taxable income. Okay, now the built-in gain tax is the lowest built-in gain of 1, 2, and 3 that we just computed above, right? The lowest of these big numbers times highest marginal rate, which is currently 21%. Okay, that's your built-in gain tax. And just like the ENPI tax, the built-in gains tax also flows through to the shareholder. Okay, it's paid by the S corporation, but but flows through to the shareholder.